August PMI suggests that the economy is improving, at least for manufacturing. I'm Rich Paz for Critical Point. It's September 1st. Earlier today, received the monthly report of PMIs, the Procurement Managers Index, and this is the manufacturing report. Next week we will get the services and then the combined reports. At any rate, I'm using the ISM's version of PMI. There's also an SP Global PMI that I look at, but in the modeling for years I've used the ISM. The ISM is sometimes a little irrational and more volatile than the SP Global. Now, PMIs normally have a strong correlation to GDP. However, last year into this year, the PMIs have gone down or stagnant. GDP has increased. The economy's moved forward. It's just a strange time that I link to inflation, and before that, the lockdown and virus pandemic recession. All of this has done something to the mechanics of what's going on, specifically with the manufacturing PMIs, not so much with the services, okay? There's something weird going on. However, I believe the market, or this PMI manufacturers, bottomed in May for a kitchen business cycle, and you can look that up online. It's KITCHIN. It was discovered in business inventories. I've learned you can discover a similar cycle in a variety of business statistics, macroeconomic data, stock market prices, commodity prices, okay? Many things in life, in fact, all right? Now, this kitchen cycle was unusually long, bottomed late. I think I took two. This is either the third call or it may even be the fourth call since late last year looking for the bottom. Now, the model did very well of warning late last year it was time for a decline in PMIs, a setback for the economy, and a setback for the stock market. Well, we were right on the stock market being down, right on the PMIs being down. GDP early last year was actually negative and triggered a signal that the country was actually in a recession. Then it quickly recovered, and I correctly forecast that from the modeling, okay? So it worked, and yet it really wasn't an economic setback. Employment stayed high, employment growth, jobs growth, more wages, unemployment stayed low. It wasn't really a recession, okay? And I wasn't forecasting a recession. In fact, I was just saying we may have some things that look like it and scare us a little bit. There's some things that need to back off, but it shouldn't be an end-of-the-world scenario. Well, it wasn't. But now it's been difficult to get this PMI to turn up. But I've said lately, it does take a sort of a trend followers approach that you need to take it above certain points within this downtrend. And the first one was to basically look at the April high, and it's gone above it. So this may still be too aggressive in timing but it is a bit like trend following where you're a little bit late on purpose to help ensure you've made the right call. I'm making another call that the kitchen business cycle bottomed in, I think I said May. It's actually June. And I think it's up now into next year for kitchen top. Now, there's probably less time now for an improvement in the PMI, but I wouldn't be too concerned with that because this is going to tuck inside of what occurs for a decade. And here is what occurs for a decade. We had the financial crisis going to 2008, 2009, and that was a juggler business cycle downturn and a related bear market for the stock market. It was also super cycles to make it more drama, okay? A potential end-of-world scenario, all right? But the juggler is a decade-type business cycle. It basically says the economy grows for 7 to 12 years, and then we have a recession for 1 to 3 years. And in 2020, we learned a recession might only last 2 months. Okay? Now, the juggler business cycle is stating that, yes, it bottomed 2008 and 9. Look how it exploded for impressive recovery growth. Then it stalled out, but spent most of its time above 50. When a PMI is above 50, the economy should be growing. And you can use just manufacturing as a clue for the economy, or at least we were able to in the past. All right? So what's going to occur for the rest of this decade is the PMI is probably going to stay above 50 in coming years, but probably not 60 or higher. And it won't matter. As long as it's in that range, the economy's growing, knocking out new record highs for nominal GDP, real GDP. The economy's going to be worth more. It's going to be larger, however you want to look at it. And the stock market is likely going to knock out record highs. That's how it's always worked. And despite all the news and all the problems and frustrations and even a virus pandemic recession, which was unheard of, something new, and then a lockdown, something new, and then all the money printing and the inflation and the greed of businesses to make more profits out of inflation, making inflation worse. These are just weird times, and yet the model's saying, really, we're getting back to a normal economy. The economy's still growing. The PMIs are going to get back above 50. GDP is going to move higher, and the stock market's going to be bullish. And I see no change of that. The most recent jugular business cycle bottom was in 2020. We got the explosion just like normal, and this has occurred since 1950s. Nothing new there. We did get a setback a little deeper than normal, and has spent more time and is more sluggish to turn up than normal, but GDP has already turned up ahead of it. I think it looks good. Now, we might want to start watching gross domestic income, GDI, and compare it to GDP. Some people are nervous that that's also sluggish and behind. It's lagging. Is it sending some kind of negative signal? I'm saying no, it's simply wrong. It's much like the PMIs, and it's going to catch up in coming months. Okay, so the next step is this should move above 50 and send us a signal that we have net growth in manufacturing, but that also should send a signal of net growth for the overall economy, and the services will get above 50 probably sooner than the manufacturing. Now, the interesting thing is GDP says, well, we're already there. We are growing the economy. And the jobs report this morning, yes, the jobs growth come down to 187,000 per month. Unemployment ticked up from 3.6 to 3.8. That's really normal fluctuation. All it's saying is we're getting back to a normal economy. We rebuilt the economy a little too fast, too many jobs. It's coming back. Now, this hopefully will also make the Fed want to wait to see how inflation develops, how the jobs develop, and the economic growth, and wait on raising interest rates. And if they don't raise interest rates on September 20th, I think the market's going to be even more comfortable with the idea eventually next year we will get interest rates down a little bit, and that things are okay. We've got a green light to be optimistic and bullish on the economy and the stock market. And my long-term business cycles, as well as the very short-term and intermediate, will help us to have an understanding of the fluctuations throughout this decade. If you're not on board, you're not a subscriber, go to criticalpointpod.com right here, okay? Learn about myself, the models, but there's also a page that will take you to the podcast host site where there's free audio and video, but mostly they're locked up under the subscription service for about $28 a month, okay? Now, there's also a page, however, right at that website that takes you to where you can subscribe. Get on board. This is going to be an exciting journey this decade. I'm very pleased how these business cycles have been working for decades. They've been very useful to myself and followers and subscribers. And I'm very pleased with what's going on in the economy right now. I would like to see these PMIs get back in line with historical performance. I think it's going to occur. I think we're on our way. Past results are not necessarily indicative of future results. Have a great day. Thank you.